Hey, thanks, Jessica. Okay. That always happens right when I start and try to trip me up. But we're being recorded, obviously. In California, you have to say that legally. I am in California, so it's quite early here. I know it's we're all in different time zones, and good morning, afternoon, evening, wherever you are. This is actually our fourth call, kind of on this similar topic. So we've been really trying to work this beat that Jessica's been leading on around small business financing in emerging markets. Call number, for those of you who are keeping track, call number 27 in March was opportunities at the intersection of gender and climate in emerging markets, and that was a mostly small business focused. Call number 25, just about a year ago, was gender smart strategies for the COVID recovery, which I guess we're still in. And then call number 12, way back in February 2020, was just before really COVID, sort of broke upon our consciousness, and a bunch of local capital providers came on, and we talked about new channels for small business financing in conjunction with the Collaborative for Frontier Finance, which has been a good partner in a lot of this. Today's call is really about what's happened kind of in the disruption of COVID and where we go from here, the glimmers of a new approach that are emerging. Jessica, why don't you just give us a little scene setting from Nairobi there. You've been there for a few weeks, been talking to many of the people on the call and many others. What are you seeing?
Yeah, well, just as sort of like framing point, like either I have a terrible memory or there are actually just a lot more informal kind of roadside businesses around. That's one thing that I've observed since I've been here. You're talking about like, fruit and vegetable stands or gardening stalls, flower shops, basket and furniture vendors. Yeah, it just seems, that there's, I would be curious to hear what Hilda and Daniel, think about this too, but it seems like there's just been an increase in those as people's other, sort of mainstream livelihoods have gotten affected by COVID. Officially in Kenya, there's 7.5 million informal businesses, and 75% of those are unregistered. And so, yeah, that's kind of just the lay of the land in terms of where the stats are.
And what are how are those businesses and even larger businesses financing themselves, and what are obstacles or problems or challenges are you hearing?
Yeah, so I've been asking this question to absolutely everybody I meet, and the impacts of COVID on people's businesses and livelihoods, and how the recovery is coming along. I mean, I've consistently heard two things on that point, and one is that there's just not adequate access to financing to help people through, and then the other one is that there's too much debt, which those things may seem at odds with each other, but like when you look at it, most of the small business owners that couldn't qualify for the limited amount of relief funding that was available, or because they're unregistered, they had to instead kind of turn around and access like quick but very expensive credit and debt. One of the most common platforms for that is Safaricom's overdraft service, Fuliza. And it's, I actually read a headline in the Standard, local newspaper here last week that was, that read, a country living on Fuliza and gambling. And, it said that, daily borrowing through Safaricom's overdraft service had gone up to 1.2 billion shillings per day, which is about $11 million. And that was a 25% increase over last year. So just kind of sets the stage really for a looming debt crisis.
So people financing themselves and their companies on overdrafts and high interest debt. Well, that's a good setup. You want to bring in our guest, Jessica?
Yes. So the folks joining us on today's call, they represent a pretty wide range of these like new financial channels that we're going to be talking about today. So first up, we'll hear from Luyanda Jafta, he joins from Johannesburg. Say hi, Luyanda.
Hi, everyone. Hi, nice to meet you all.
He started the People's Fund in South Africa to give Black-led businesses there access to upfront capital to fulfill client orders, so also called purchase order financing. And it's not new, but the People's Fund's angle on it and crowdfunding approach is pretty unique. We also have Hilda Moraa, also here in Nairobi. Hi,
everyone.
Hey, Hilda. She's the founder of a small business fintech called Pezesha, and the company is both a lender and a high-tech financial intermediary. Working with companies like enterprise tech companies like Twiga Foods, and also banks, investors, and other financial services firms. We also have Daniel Goldfarb, who heads up Lendable. He's a lender to fintech companies. Say hi, Daniel.
Hey, everybody.
He'll offer his views on some of the availability of small business financing and, whether and how the fintech boom is actually getting more capital to businesses that need it. And then lastly, we have Daniel Kimotho, who is also here in Nairobi, who joins us from Celo, which is the innovation team for blockchain platform Celo. Say hi, Daniel.
Hi, everybody.
Cool. And he's going to talk to us about crypto and how that's bringing down the cost of capital, and being used to pay gig workers and finance small businesses, et cetera. So yeah, with that, anything else from you, David?
Well, I was taken, Luyanda, we had in the brief this morning, and I was taken by your quote there, which said, why aren't the banks doing this? Which has kind of been, sort of the refrain, as I said, through many of these calls, is why hasn't this, why isn't this we said, small and growing businesses is a big and growing opportunity, but it's still underserved by the traditional financial institutions. So I don't know if you want to just jump in there, Luyanda, or you had a specific question, Jessica. You can take it back if you like. So that might be a good place to start.
Yeah, actually, I was gonna just ask, like, Luyanda, the People's Fund, as I just sort of mentioned, crowdfunds purchase order financing for small businesses, and it's not really a new type of financing. I think you said that yourself, and it actually seems to be kind of low risk relative to other types of business lending, since it's based on, basically companies' commissioned work. But why do you think most businesses you serve have not been able to access that kind of capital historically?
Because banks primarily function, thanks Jessica, thanks David. Banks primarily focus from a lens of risk, not from a lens of opportunity. I heard David mention the idea that the opportunity seems so obvious, right? By some training, a little bit before I dropped out of varsity, I'm a mathematician and inefficiency grates me. And so the quote you were reading, it just speaks to that. It's such an obvious thing to do, from a financing perspective, but primarily how I only want to speak on South Africa, but it seems like it extends across the continent, is that when you look at businesses from a risk lens, what you often do is you use, there's a book I'm reading, what's it called? The Weirdest People in the World. And it speaks about the cultural nuances of various regions within the world. And in the African context, one of the things that we made a mistake with, and South Africa is very good at this, I think we've got the biggest booming financial sector on the continent, is we took Eurocentric financial models and applied them on an African context. So generally what it does is it creates this cultural mismatch in terms of what we consider funding and what we consider productive funding, right? And the banks just can't understand how to evaluate risk in that context from a South African perspective, at the very least, where when you've grown up in the place, you've grown up in the environments, you know how debt is provided, actually, in truth, right? And that's why banks haven't jumped in. Like you said, what we're doing is it's not new. It's actually annoyingly not new. It's annoyingly not new. The only thing we did different, like primarily outside from the merging of the crowdfunding and the purchase order funding or financing, is we actually said, look, instead of charging an interest because of how the credit regulation is written, really small businesses from able to put productive capital unless they show a long history of how they've operated, is why don't we go a profit share route, which is very common across the continent at the very least, where we say, look, we'll provide you the funding, we'll do a profit share, then we move out of the credit side of things from a technical perspective. And how we're operating is we're saying, listen, we want you to have most of the profits, almost 7 times the profits on each transaction, and keep that for yourself, but we'll participate from a capital perspective. And then the flip side is that with these very sophisticated financial markets, the interest rates you probably generally get from banks and that sort of thing is not something that entices people, and people want to have more direct impact and participation in the economy that they exist in. So the crowdfunding was just people saying, look, we want to be part of the solution, but we don't know how. And that's the thinking from the People's Fund, is that how do you build a people-centric economy that is led by the people, and the people are at the front lines of that. So it's not new. It's just a crazy idea where you put people first in a society, you know.
Yeah, I mean, I was actually going to ask you about, you know, the People's Fund's deeper mission, which I realize we could probably easily take up an entire hour with that question alone. But I mean, in brief, you know, you talk about, you know, putting Africa-centric, you know, business or financial models, like, you know, back at the heart of, you know, South Africa's financial system. I mean, what is, you know, what do you hope the impact, you know, the broader impact, I guess, not just on businesses individually, but also, you know, for South Africa's overall economic well-being will be from that?
100%. So I think one of the things in South Africa, we call them stokvels. I know they're called by different names all over the continent. And one of the things about putting those at center stage, you know, if you think about it, these are crowd saving schemes, right? So when we like to joke at the People's Fund that crowdfunding is just a stokvel that went to private school, right? What we want to do is people to see the power and the impact they have in their individual silos to be able to impact the economy in such a significant way. If you think about it, like stokvels make up 66 billion in savings in South Africa. South Africa has one of the lowest savings rates of most developing countries. But that's because primarily nobody's measuring how much goes into stokvels. And what we're trying to do is, our mantra is change as is. Or rather not our mantra, but our business promise is change as is. And the as is we want to change is first people, how they see themselves, is that you're enough as you come, as you are, but also let's change the system as it is. It's not designed for you. Let's design it so that it actually works for the objectives that we're trying to achieve collectively as a society, instead of adopting things that look pretty but don't functionally work in an environment where you have very high levels of poverty, very little access to opportunity. And how do you work around all of those things for the people who are striving?
Luyanda, just explain maybe a little bit about how it works. Like, who are your lenders? You have some big lenders as well as then smaller lenders. Are they picking specific companies to back, or are they backing you generally? How does that work?
Sure. So typically how it works is I'll start the process from the beginning. I'll speak fast. I've been told I can speak very fast. I'll try to do that. So typically how it works is Tsepo comes onto our platform. He's won a contract with Transnet or one of the big corporates or one of the big institutions for 200,000 Rand. He needs 100,000 Rand to execute on the order, doesn't have the capital. He comes to us, applies on the platform, on the website, and requests the capital. Then what we do is we do a thorough due diligence. Then what we do is we take that 100,000 Rand and we split it across different funders. Now, to answer your question specifically, our funders are everyone contributing from as little as 100 Rand, which is about $8 US, all the way up. We've got one institution that's contributed 8 million Rand, and then we've got a wholesale agreement for that we're going to get a 30 million facility with a wholesale lender for that, right? So what we then do, we split it proportionately according to what funders have put into the fund, and then everyone is participating in it, big and small. So you got your average Joe or Joanne, and you've got all the way up to institutions that are participating in the fund to move the contract forward. What we do is we actually pick the contracts for them, basically meaning that we divide them equally across the various contracts. Then what we do, we say, listen, Tsepo, we funded this order. Basically what we're going to do, we're going to buy the goods from the supplier. We're reselling them to you on terms. And what we'll do is we'll wait for you to get paid so that we can also get paid. Then we charge a simple flat rate, usually 6% of the value of the order. So Tsepo leaves with 88,000 in profits. We take back our 100,000 in capital, and we've charged him a 12,000 Rand fee for facilitating the transaction. That is much lower interest than they would get anywhere else, presumably. So it depends. So if you're looking at alternative lenders, yes. Why we're angry that banks don't do this is because banks have the infrastructure to be able to offer a much lower rate. Now, in the market we operate in, nobody can actually do what we do almost no one, because we have a technology focus. So what we are able to do is do a thorough due diligence on the risk and the vetting of all of those things, but at a level where we could even offer somebody 10,000 Rand in funding. So what we try to move away from is the idea of offering interest. It depends how long the project takes, right? To see how long, is it cheaper, more expensive than banks and all of that stuff. What we've said is, listen, we want you to eat. And that's the thinking we sort of have to inculcate in everyone, is that if we say simply interest, if somebody's got a 5% margin and we're charging even a low interest, if they take a year to do that project, they're not going to be left with anything, but they had cheap interest, right? So what we're always trying to do is say, how do we leave you with some on your with a lot on your table, and we share some of those proceeds. I hope that answers it, David.
Yeah, indeed. The risk is low because you've got the actual contract assigned to you, so you know that the company's going to get, and then you're going to get paid, right? So
yeah.
So again, just back to the original question: why are banks not doing this?
There's a number of reasons, right? It's the risk perspective. One is the PR perspective that, for example, that government has in South Africa. It's a funny one. Government is known as the non-payer in South Africa. Now, we've been doing purchase order funding for 4 years. We've outlaid, I think, about 300 million in capital to people. Sorry, that I don't know, I forgot what that works out to in. It's about 20 million US dollars.
20 million, yeah.
That we've outlaid. In that process, we've done almost 2,000 contracts. The best payer in the country, by far, bar none, is actually government. We cycle through these contracts anywhere. So our average time is 49 days. That was mostly because of COVID. It was much lower from the time we deploy capital to the time it pays back. That number used to be much lower. The thing that did it is actually corporates. Corporates are the people who actually bankroll their cash flow through the small businesses, because who's a small business going to go to when they have to fight a corporate for payment? Government is actually one of the best payers in the country. So that's one of the reasons why banks don't fund them, is the perceived risk of government, as an example. And the PR back for fallout that is potential is persistently around when you're dealing with government.
Cool, great. Luyanda, thank you for that. I think, you sort of left us on a good, point with this risk question. And Hilda, I'd actually like to turn to you, since this is something that you deal with day to day at Pezesha. It's interesting, since I've been here in Nairobi, I feel like all the conversations kind of come back to Pezesha. I think it was actually one of your local enterprise tech partners here, Market Force, that introduced me to you guys. And we've been reporting on this. There's a lot of new companies like Market Force, which are providing services to informal and small businesses. And I've heard from a lot of them about the need, to sort of digitize informal and small businesses. And I'm just curious, what your take is on on the need for small business digitization, and like what the opportunity is there, and what it's doing, around this sort of risk question for business lending.
No, thanks, Jessica. And of course, I'm still going to make sure we meet in person. You cannot leave Nairobi without that happening.
Good.
So basically, just let me describe what we do at Pezesha. We are basically, we have built an operating system to basically power embedded finance. And I'm going to try and break that down in my conversation, because I know some of these terms, for some of the people in the call might be really new. Embedded finance, what does that really mean? And really what we do at Pezesha is we've been able to democratize our working capital by connecting the underserved small businesses, as you're mentioning, with access to affordable capital through seamless integration with the existing workflows for our partners. And so, of course, Market Force is one of our partners we've integrated with, and we provide credit to their merchants, similar to Twiga Foods, similar to Jumia, and we are their biggest lenders in Kenya. And so what that really means is we've done the hard work of integrating our rails on top of their workflows, and we are sitting in the back end embedding and providing that credit in a more productive manner and efficient way than ever before, and allowing their merchants to be credit scored with alternative data that these partners send to us, and we do real-time credit scoring, and then we can be able to provide them with loan offers. So where a merchant was not having any credit history, now we can be able to provide that in Pezesha real-time, because we have transactional data, which is real-time, it is complete, which is really to answer the question you asked, Luyanda, why are banks not doing this? Because it's an information asymmetry issue. You know, they cannot be able to do this in scale way of seamlessly. Sorry
about that.
We've integrated seamlessly with these partners to be able to, one, access data, complete data sets for these merchants where it never existed. You know, so where credit history never existed before, especially for the women SMEs, we're now able to offer them a credit score for the first time ever in the Pezesha ecosystem.
Hilda,
And so for us, this transactional data, you know, is anything with what they're transacting with these partners, sales orders, payments history. We're able to, of course, with the consent of the business, access their data to, you know, the payments they're making with Safaricom and any other provider. And we then generate through our algorithms a real-time score to then be able to allow them to get credit from these partners and grow their business. Now, that's not where it starts and ends. We then are able to then, you know, provide a way to ensure that this credit is productive. How do we do that? We do not lend to the merchant. We buy the goods on their behalf through our partners. So if a merchant for Twiga wants to buy products from Twiga, we then send Twiga the money, and then the products are delivered to the merchant. So we ensure that the money has been used for productive use. And like what we are seeing in the market, to the point you made earlier, the over-indebtedness behavior is as a result of moral hazard that players in the market haven't been able to clearly identify ways of monitoring what is this capital being used for. And that is the same reason why banks can not be able to come into our space, because it's a lot of work for them to monitor, you know, where is this money going? So you end up charging crazy costs or selecting, or, you know, specific customers. And essentially what you're doing there is credit rational, you know, behavior, which then means you're excluding a lot of people. Now, the third piece is we now know where the money is going in the entire value chain. Now, the third piece is collection, which is one of the biggest problems. And I'm sure some of my colleagues here, including Daniel, can mention that's a big one. Now, we have been able to automate that component. We don't need to hire 100 people to sit in the office to collect. So what we do is we have a wallet that sits in between our partners where we can be able to do auto debits. You know, so when the merchant is late or when the merchant has come to their time of payment, we automatically debit the wallet that is in between us and them and the supplier, you know, in the assumption that they are being paid using the same wallet. So in the case of our partnership with Jumia, it's the same thing. So these are just some of the examples just to bring practicality into really what we do. There's a lot of backend, you know, APIs speaking to each other. And this is how we've really tried to mitigate the risk. But of course, in the end, our credit scoring models really leverage on complete data. We're not necessarily just looking at one siloed data as we've seen in the market. We're saying, hey, what is this merchant, you know, transacting? What is the behavior in their previous credit history? You know, what is their entire business? So we have a clue of helping them to digitize their traditional records or their manual records with the tools that we offer them as part of the solution that we provide. And then we're able to then collect this data on a continuous basis and incentivize them that really if they continue to transact with us and collect this data, then they can grow up the Pezesha ladder and become credit worthy and even access much more bigger loans with the mainstream channels. And so we're really excited about that. Again, for us, we've been able to prove this and validate this with more than 20 partners in the market in the supply chain sector. And COVID has really been a lot of opportunities to as we've seen value chains aggregating, consolidating. And I think this is the time to really grow aggressive with our model across Africa.
Hilda, I just want to put an exclamation point on that because you said the availability of data is key to the whole model, and the availability of data at some level is dependent on this digitization trend. And so and you said COVID has opened up opportunities. How did COVID accelerate that whole digitization trend?
Yeah, so what we've seen is, of course, many businesses and many partners that we're working with were looking to retain their customers. But they had to think about how to really, make sure that their distribution models continue to survive. And so what we saw, as the first layer of that opportunity was, most of our partners were looking for ways to continue to have that relationship with their retailers or with their customers, in this case, B2B. And so, credit played a very big component as a tool to really ensure that these businesses continue to survive. And so they came to people like us and said, this is not our core business. Can you help us to really ensure that we keep these businesses? So we were able to enable credit, in an integrated manner for these businesses. The second part of it is, of course, where we've seen, majority of these businesses that were thriving, during the COVID period, they were affected. They were dying, almost dying, and they knew if that happens, they were never going to come back again. And so, they were looking for ways or people who could help them, to survive and thrive during COVID. And so credit was going to play a big role to really ensure that they keep their cash flows healthy, and more importantly, their business continues to thrive. And so for us, we took advantage of that opportunity to educate a lot of businesses, through our financial education modules of how can we help them, to survive, and bringing this safety of credit for them to be able to go through COVID. And of course, in the end, they can also be able to come out as a winner. And for us, then we connected these businesses with credit opportunities, but also we gave them flexible, affordable credit, which was not hurting their business at all, almost interest-free, to say, hey, this is a chance for you to stay. And in the process, we used our tools, our digital tools, to collect data as an incentive to bring them to the formal, or you'll call it the Pezesha system. And so this is an advantage that we took as an opportunity to say, hey, you want to grow up the credit ladder? We need data. We need to start building your credit score. So there was a lot of financial education that went into that effort.
Interesting. That's terrific. Thank you, Hilda. And that's a good transition to Daniel Goldfarb from Lendable, because you're seeing, I think, this, Daniel, and you can tell us how Lendable works, but you're seeing this across markets and across different kinds of models. And so my question is sort of the same. What's different now than before the pandemic?
Yeah, so maybe I'll just give a quick kind of background on Lendable, and then I'll jump into kind of what we saw before and then after the pandemic. And just really thankful to be here. A lot of familiar faces on this call. Also really excited that this is live from Nairobi, a city I lived in for 5 years and have a lot of love for. So shout out to all the Nairobi folks on this call. So Lendable's a firm that myself and my co-founder Dylan started over 6 years ago with the really simple belief that Fintech had the power to create a more economically just world by increasing access and lowering costs for the people that most need the access to financial services. Many of the folks that are the hardest working folks in the world, as we know, don't have access to the services that allow them to move from being renters to owners of goods and businesses, which allow them to generate income. Lendable takes a kind of one step up approach from the awesome work that Luyanda and Hilda are doing. We fund the fintechs. So our belief is that in every market, there are dozens to hundreds of really interesting new ideas that are changing the way that people get access to financial services. And we're never going to be smarter than the people starting those businesses. And so we want to support them. And we support them with debt. So we're not an equity fund, we're a debt provider that's built our own technology. So we're tightly integrated via API to all of our partners so that we can monitor the portfolios and provide scalable debt solutions. As many of the folks on this call have started businesses know, raising money is a pain in the butt. And you end up spending most of your time not building the business you want to build, but walking around with your hat out trying to raise money. And so what Lendable tries to do is come in once companies have a clear idea of their business and then help them scale. So we go down to as small as kind of $2 million. Our biggest position right now is about $25 million from us. So we scale pretty big with folks. We've lent a little, right around $200 million over the last 5 years, growing really fast. So we're doing anywhere from $10 to $15 million a month right now of new financing to over 25 partners we financed across Sub-Saharan Africa, North Africa, Southeast Asia, and now Latin America. As I mentioned, I lived in Nairobi for 5 years, and Sub-Saharan Africa is really where we cut our teeth. And so that's the space that I personally know the best. And so as David, you pointed out, we have this kind of industry-wide view. While we finance 25 fintechs, we probably due diligence 75, and we've talked to a few hundred and 500-600 fintechs. So we have a pretty good idea of what's happening in the industry. And there's a few trends that already have been touched on. I think like the core trend that was already happening before COVID, and COVID just accelerated what was, for anyone in the industry, we already knew was happening, which is we're moving from digitally enabled fintech, meaning, the obvious example being M-Pesa enabling the whole ecosystem that exists around M-Pesa in Kenya, but all over the world, digital payments enabling new delivery of services. We've gone from this digitally enabled environment to a digitally native environment. I remember right before COVID, I was trying to explain to one of our newest team members in Kenya, dial-up internet. And they were like giving me this look like, what are you talking about? Your computer used to make horrible noises and you couldn't be on the phone at the same time. And we've now entered a world in which most people entering the industry have always had a smartphone. That was just what they knew. And as people start joining, the workforce with that as their background, suddenly we expect our financial services to look a lot like everything we do, right, on applications. And so we're seeing kind of, we saw an unbundling of financial services, I think in the last decade, where banks, which used to offer the whole suite of financial services and were the only players in town, suddenly start getting disintermediated with specific use cases. So somebody's offering a loan here or an accounting service there. And now we're starting to see a rebundling of these services and embedding of them into your workflow. And I think Hilda put this perfectly, and I think this was being alluded to by Luyanda, is like, ultimately, you don't want financial services. None of us wake up in the morning and go, I really would love to find me some financial services to integrate into my life. No, you want to do something, right? You want to start a business. You want to buy some food. You want to buy more inventory. And you want a real world outcome. Financial services just enable that. And so at their best, financial services are invisible. And that means they're almost inherently digital, because if they're not, you're going somewhere in person to do something. And so what we saw before COVID was the best companies were already starting to do that. What happened the second COVID hit, a lot of our LPs in our funds, we have, LPs all over, investors all over Europe and the US who put tons of money into our funds. I got, the nervous calls, somewhere like March 12th of last year. All these people, oh my God, are we going to lose all of our money? What's going on? And we have this view into the data of all of our borrowers. And one of the first things we noticed was everyone that was only using digital payments, their business grew very rapidly in the first few weeks of COVID, because as everyone started to scramble, people didn't want to go into businesses. And so suddenly they were downloading the apps they had always wanted to, but never made the time to download. They were starting to do more digital payments. And so the digital payments industry, we finance a lot of remittance companies and the infrastructure behind them. So like MFS, for instance, a very incredible company out of South Africa that does the infrastructure for cross-border African payments. In that instance, we saw across our portfolio of digital payments a 30% increase throughout COVID in transaction volume, at the expense of the brick and mortar players, at the expense of MoneyGram, at the expense of Western Union. And so the digital ecosystem started ballooning, and then the lenders that lend on the back of that suddenly had, essentially more pipes to push their product through. So we actually saw an uptick in certain types of business. Granted, not everything was equal, right? So if you're an MSME lender that lent to retail or restaurants, there were lockdowns, that was painful. And so there were very, targeted specific areas of credit issues in the industry, but overall we saw very little disruption to our portfolio, which was super exciting.
Well, so let me just put it to you, because this is kind of what we're trying to sort out here is there's been a gap. The development finance institutions have been trying to fund small businesses for years with mixed success. Is there really a new sort of attitude, approach, solution at hand here that has lower transaction costs and better risk underwriting and a whole kind of new schema that could actually unlock financing and then thus unlock small business growth and livelihood, as you said, and incomes?
Yeah, I think this goes back to really what's the role that different players play in the market. So we started with this question of why aren't the banks doing this? We joke all the time at Lendable about if you approach everything from a systems perspective, ultimately we all have incentives. In the immortal words of a rap group in the US called Wu-Tang Clan, cash rules everything around me. So whoever gives me my money, ultimately I do what they want me to do. That is the nature of business. And we all have different roles to play. I would argue the reason banks don't do this stuff is the primary role of a bank in society is to hold your deposits. Banks started doing lots of other things in the world that maybe they should have never been doing. And that banks are infrastructure companies, they're regulated infrastructure companies, and they have like a near holy responsibility to not lose your deposits. And so should banks be doing risky new things? I don't know if I think they should be. I think there's firms that have lots of upside that should be doing them. The firms that are on this call that get to capture that upside and aren't holding people's deposits. So if they lose, they only lose, their time, and they're really hard fought wins, but they're not losing, mom and pop's money. And so I think that if we look at the different roles that are being played in the market, what is so interesting is the disintermediation and unbundling of services has allowed for people to take risks that a bank could never take. And so that's what we're there to finance, right? The question is, when somebody really hits the nail on the head for a business model that is serving a new client base with a new product that never before has been in the market, how do they scale? That's a really tough and challenging question. And that's where our role in the market comes in, is how do we finance them? And we have LPs that say, if you can give me the right returns and the right impact, I want to finance that, and all the way up that value chain. So yeah, I would argue there are fundamentally new models. They're only enabled by the fact that you can suddenly offer these very tailored solutions, which allows you to play a different role in the market. And we are seeing kind of a fundamentally new modus operandi. And we just actually raised a new fund around this. So we just raised a $100 million fund that's financed by a bunch of development finance institutions, institutional investors, impact investors, dedicated to just what we call the opportunity. So just financing MSMEs and their digital ecosystem around them to create opportunity through fintechs. So all based around this thesis that this has happened, it is new. In the wake of COVID, it's only growing, and someone needs to provide the scale for it.
Okay, so glimmers of a new system. Let's come back to that. But Jessica, let's move on to Daniel number 2.
Yeah. Hey, Daniel. Actually, I'm gonna jump off of a point that Daniel #1 just made, which was around, he said that he's not actually sure that traditional banks, should be doing more of this kind of work. And I feel like you might have some thoughts on that. Actually, I think you and I had an earlier discussion about this, where you told me that you felt like actually the traditional financial systems were kind of, at their capacity and maybe like trying their best, but sort of like, at the limits of like what they're really allowed to do in this space. And so what is that, what does that usher in terms of like the opportunity for crypto platforms like Celo, and the type of work that C Labs is trying to do? And like, what are the benefits there over, more traditional forms of financing in this respect?
Yeah, and thank you. I think that is a really interesting question. And I do agree with Daniel on that point that, everybody is doing their job. And because everybody is doing their job, especially the traditional banks, they are all busy doing their jobs. And therefore, they are kind of maxed out on the kind of things that they can do. And therefore, that creates this new opportunity where disruption has to come from outside. Typically, we have not seen disruption coming from within a system. And so crypto has come in somewhat like from the outside, and that is why it seems to be operating like a totally different thing entirely, very disconnected from some of the mainstream things that we know, and it's still growing and surviving by itself. Of course, it does benefit a lot from cash in and cash out rails, where people get to convert their fiat currencies from their crypto assets, and therefore realize the real world use of the value that has been generated from within the crypto ecosystems. But generally, we are seeing a lot of innovation happening from within the blockchain ecosystems. We are seeing a lot of growth happening there, and it is also attracting a lot of talent. And that is a new opportunity where many people are being called in to the industry. It's really attracting a lot of people. We also joke that, people leave their 9-to-5 jobs so that they can work 24/7 on crypto. And that is a trend that I'm seeing with many people who just once started in it, somewhat like get hooked, and they see all these possibilities and potentials of what they can build. Because crypto in itself, or blockchain technologies, bring with it some inherent qualities that then allow people to think bigger. You may find that while you are able to think about a certain region for your financial service, which Daniel has aptly put it, that these are supposed to enable real world change, real world outcomes. So while you want to help people bring about real world outcomes in Kenya, when you bring about the concept of a blockchain, then now you can think broader. You can think broader, and it's at a lower cost. You can think doing it across Africa because the whole network is laid out for you, and you would not have to have very many, or rather such a huge capital outlay in setting up in all these different areas. And so that is the new opportunity that we are seeing, that this technology enables scale quite fast. It enables scale quite rapidly and quite affordably. And at the same time, it is at the back of some of the protocols that have been designed, especially to tap into this new opportunity. So blockchains in themselves have been evolving over time to serve different functions. Of course, the first one and the most popular, Bitcoin, came about in 2008, 2009, and was the catalyst for this entire revolution that we are seeing. But over time, where Bitcoin itself has not been able to fully meet the needs, the real world outcomes that people need, other technologies have then emerged to serve more real world outcomes. Ethereum came about to serve those other real world outcomes by having it that a blockchain can be programmable, that you can write in different commands and different statements for certain outcomes to take place given certain kinds of inputs. And there emerged a whole lot of innovation from that ecosystem. But then where also Ethereum reached its limits, we then started seeing other networks coming up, and especially networks that were now mobile first, focused on where the people are. People are using their mobile phones in their day-to-day transactions all over the world. And therefore, blockchain, while it is quite an innovative set of technologies, is now moving to where people are. And this translation and this growth is where Celo has capitalized the opportunity, and not only by going mobile first, but also going carbon negative, because this is also something that is really important for us to be sustainable in also the technologies that we are building. So looking at what we have now, the current traditional financial system and all its limitations, and then asking how do we evolve something newer, something better, something that can enable real world changes while bringing about the kind of effects that we want to see across, like being carbon negative, and enabling more people to access prosperity. And prosperity is that real world outcomes that everybody wants to use. So Celo in itself is a financial system, at the end of the day, that is supposed to enable prosperity, this real world outcomes to come about. And how that looks like is through partners such as Pezesha, who we get to work with, who integrate the technology and who get now to scale and to leverage some of the benefits of using the technology. So for instance, for a lender, they may start getting some of the benefits of using blockchain technology, which perhaps maybe we can chat about if you like.
Daniel, I just want to press you. I mean, crypto is such a sort of wild west, and has a reputation of sort of anything goes. You're, I know, trying to very much focus the efforts on inclusive crypto, and as you said, get these positive social impacts. What are the sort of key levers or guardrails that are needed to make sure that it can fulfill that? People I think oh, it's all going to come crashing down, everybody's a bubble and people lose their money, but what makes it inclusive crypto?
Right, and that is such a great question. And yes, while crypto in itself has really benefited from that whole renegade approach, that is at the forefront of innovation. We are also seeing that many other organizations are then taking up all this innovation that has been built out and are integrating it into their work streams, into their financial platforms. And then we are getting to see organizations such as the ones that we have within the Celo Alliance for Prosperity, getting to build on top of Celo and extend the capabilities and the technologies and all the benefits, the cost savings to their end users. So for instance, you may find a remittance company that was perhaps, only focused on a small geography, now able to cover a wider region and at a lower cost, thereby reducing the end transaction costs for their customers, and also having a financial upside for their own business, a profit for themselves. And looking at that lens, then we get now to see how those guardrails are coming in, because they are being adopted to serve those real world outcomes in the same frameworks that we know about. So in the same frameworks of KYC and due diligence and AML, checking each transaction. So those things don't go away, especially if a business is to reach many people and actually serve people's needs.
Terrific. We were joking in the pre-call that we've just invented the first global small business financing platform. It's basically people's fund purchase order financing, vetted by Pezesha's alt credit scoring, and all linked together with Celo's crypto platform, and financed and funded by Daniel Goldfarb at Lendable. What do you think, you guys? And you can do,
I got to talk to my lawyers.
I think where we sit, absolutely. I think all of us have an opportunity to collaborate. One of the things that we really look at Pezesha is the cost of funds. And why we are really excited about our partnership with Celo is we've been able to layer blockchain, nothing new on our infrastructure. We're not building anything new. We are using blockchain to layer access to pool of liquidity that never existed before on our infrastructure at a very affordable rate. And so for us, cost of funds is very key. And that's why, of course, we've tried to work with banks. And if the cost of funds don't make sense to our business, the entire value chain doesn't win, from the supplier to the retailer, to Pezesha, and to everyone involved in that ecosystem. So we find alternative ways like blockchain where we're currently partnering with Celo, and we've fully integrated and tested and proven this model, where, you know, when you start accessing capital from investors who are already investing in those chains, and now we can change the fiat to local currency, you know, we're starting to see those are some of the alternative options. And I'm not saying I'm not ready to take Lendable's cash. I'm just saying that, you know, for us, that's gonna be the underlying aspect, cost of funds. And if Daniel can confirm that works, absolutely, I'm open for this partnership.
But maybe Luyanda, just I'm curious, like, could you take, could your lenders to the small businesses be cross-border now, or would that be a big hassle in transferring the money and whatnot? And maybe we don't even need Lendable if you could open it up to cross-border crowdfunding.
So yeah, we've had a few international crowdfunders, right? They were doing fairly sizable transactions. The biggest problem is getting money out of South Africa. That's the biggest headache for these transactions, right? So it's the nitty-gritty details that are tough, but it's not technically impossible. It's just in the simplicity of the People's Fund trying to be simple. It's finding better ways of making it happen, and Celo might be the actually perfect thing with the crypto play, where it becomes easier, because I know even we were part of IFWG, it's an intergovernmental fintech working group, where we're trying to figure out how to regulate these sorts of industries, right? Our industry, the crypto industry, and the remittance and how that would work from a remittance perspective. But our country is not very friendly with getting money out. Go ask, who was the guy who went to space? The billionaire. Our country is not very friendly with getting money out of the country. That's the only impediment.
I think we've got Ani Patenpower on the call today. And actually, Ani, I know you know the People's Fund quite well, and that you've also been really involved in working on, you know, some of these kind of creative financial structures, you know, that are ultimately sort of serving small businesses. So I'm just kind of curious what your take is on what you've heard from these guys today.
Thanks, Jessica. Always great to be on these types of calls, and great to see all of you. Hope you're doing well. I'm always amazed at just how much people can build in these types of verticals. And I think that the work that each of these organizations have done, and, you know, David, as you said, like, you know, this is essentially a vertical. Like, what we're seeing now is everyone's identifying different pieces of the obstructions. So like, what's the obstacle to this financing? And I think, you know, as Daniel said, going all the way up this vertical, we can have the work that, you know, Luyanda's doing and Hilda's doing, but we actually need the funders to fund those. And so we need to even go one step further. And I think what calls like this are really important to do is to actually get through some of these asset owners and to say, hey, this is what needs to be invested in, because this is how money gets, you know, moving. I mean, Luyanda has been doing tiny checks in comparison to, you know, what other people would say are investable. And so you tell a bank, you know, that they need to write a 20,000 Rand check for some of these small businesses. It's not worth them getting out of bed in the morning. And so I think that it's, you know, the lubrication that Luyanda is doing and that Celo is creating to be able to do cross-border. There's all these different pieces that these practitioners and others are actually unblocking. And so there is starting to be a need just really for the capital to flow through some of these intermediaries. And I think that's really exciting, because there's a lot still for us to figure out. And there's a lot of these instruments that are going to be, you know, we still have to test, and, you know, there's a lot of things that we can do wrong, but it's really exciting to be getting to the point where the infrastructure is really starting to be built. And it's about the capital actually flowing through. And in some cases, really tried and tested and true. I mean, I know 300 million, $20 million doesn't sound like a lot of money, but 300 million Rand is not a small amount of capital to go to really small enterprises in South Africa. And the infrastructure literally that Celo is having to build on the blockchain side is going to enable a lot of different types of transactions to really flourish in very small bite sizes. And that's what we need.
just want to say we're coming up on the top of the hour. So obviously if you have to leave, that's up to you, but we're going to keep going for a few more minutes. So if you can stick around and we'll keep the conversation going for another 15 or 20 minutes. So just wanted to say that as we come up on the hour. Thank you, Ani. Jessica, we have some questions from the text. Do you want to queue a few of them up?
Yeah, actually, so Hilda, Luyanda, I don't know if either of you have to go, but if you've got a couple more minutes, I've got one actually that I think is good for both of you. We had a question from the chat that says, as you build these solutions with a focus on working capital needs, what other financial needs are you seeing amongst your core clientele that the market is not delivering? And so, Luyanda, I mean, I know you started actually with asset financing, and you found out that was not particularly in high demand. So what else are you hearing, since you started doing the purchase order financing?
Got you. So primarily outside of purchase order financing, broadly, the more broader working capital financing for getting from month to month, that's the obvious one. And then the asset financing is actually a requirement for the businesses as they transition out from the level where we finance them, right? So we try to do very small checks, as Oni was saying. We're trying to do the very small checks, bottom of the pyramid, grow them, and then graduate them into another financial institution. Because that's where we think the real opportunity for transformation is. But asset financing is big, it's fairly sizable. I want to be careful with answering this because what we often find is the thing that's demanded the most is because there's a problem of, I want to be careful with my words and be accurate with this answer, is there's an image of business that is created in society and then there's actual business. So from the businesses that are fundable, working capital, asset finance, etc. There is a big gap for VC, but I think more than venture capital to get businesses going, I think we actually have a different problem. There's a big financial literacy problem in South Africa, more than anything. More than money, the problem is how we think about cash. I think that's more pressing than anything else if we want to truly transform the economy so that there's more participants and then we can actually find the businesses that we fund. Because most people are looking to get funding before they start the business, before they get their first customer. We get a large demand for that, but I think that speaks to lack of lean startup and all of that other stuff. But if I was to just focus on the businesses that are already operational on some level, easy access to credit. So that's part of the reason why we were part of the regulator's sandbox, is to go, you're thinking about this wrong. Like I know you're thinking about risk, but how you need to think about it is actually think about it as you're a means for poverty alleviation. So it's easy. So what Hilda's doing is actually very important. And I dropped her a line to say, listen, let's have a conversation. Because if you can transform how people get fed into the credit system, you can transform their lives quite intensely. I hope I'm making sense. I can waffle sometimes because I get very passionate.
Yeah, no, that's good. No, that's great. Hilda, I don't know if you're, if you have an answer to that too, just in terms of the types of financing that is being demanded. So.
Yeah, I mean, we're starting to see, as I mentioned, one of the trends we're seeing because of COVID accelerating that trend is value chain, credit, working capital. So, from supplier up to down the stream to the last mile, and so we started off with last mile credit financing. Now we're going up the stream. Now we're currently working with distributors. We've gone up to do trade financing. We thought, we're always going to be a last mile company. Now we're starting to see distributors demand the same credit, suppliers asking for the same. So we are starting to see a need for credit across the entire value chain. And now it's a closed loop. You have more data. You can be able to, create an ecosystem that is so tightly knit that keeps everyone in check and responsible for repayment behavior. So that's what we are seeing. And of course, on top of that, we're seeing the need beyond credit. People are asking us, for example, right now, okay, fine. We really love working with your affordable credit. It's really helped our business. Can you help us now, to provide, an opportunity to streamline our books? How can we record our books in order? You know, how can we start building our credit history? And we're starting to see more of that come to our request. We're also starting to see most of these SMEs that we've already empowered starting to ask for, financial education, as it's been mentioned by Luyanda, asking, can you help me to manage my cash flows? Can you help me to manage my business? I don't know how to grow. I don't know where to get employees. And so we're starting to create this digital ecosystem on top of that. And we don't have to do everything ourselves. We're asking the right partners, come, let's work together, because our model is very collaborative. We don't have to do everything. We're building the rails. You can come and lay on top of our rails.
Daniel Goldfarb, I mean, to Ani's point about the scale up, you've done impressive job in being able to raise capital from multiple different sources. Also, as we wrote a few months ago, sort of parsing out the risks and returns so that different investors can get the kinds of profile that they want. Maybe you could just say a little bit about how that works and sort of what the prospects are for bringing in much more capital.
Yeah, I mean, we view one of our primary roles in the market as like the interpreter between the fintechs and the institutional capital providers. They do not speak the same language. So, I myself have founded a company. I understand the like day-to-day of running a company from 0 to 1. And, the things you worry about are, am I going to be able to pay my staff? Was I a total idiot to start this? Am I wasting my time? Like all these very human questions that really are very stressful on a personal level. Whereas the institutional investors, they worry about, am I going to lose money? Am I not going to get a bonus this year? It's a very different set of concerns. And so there's really kind of like two things that we've seen have been essential to scaling. Because the first, we've been around for 6 years. The first 3 years raising money was so incredibly hard. The last 3 years, it's gotten much easier, all the way to the point that this year, we've stopped allowing new investments for Q4 of this year because we have so much capital at the moment. And the two changes that I think occurred, number one is there was just an education piece, and we take this role really seriously in the market. Like, if you want to close an investor that's going to invest 10, 20, $30 million, you're going to know them for multiple years before they invest, especially in the institutional space. In the consultancy space, where the people that advise pension, endowment, insurance, they have a whole process where you just update them every quarter for 2 years before they even take a DD call. And so, I've been in the Netherlands, Belgium, Germany, and London in the last 8 days. And that's because a few times a year, we do these trips where we just educate. We go sit down with big institutional investors and we say, we know you're not going to invest this year. You probably aren't going to invest next year. But let me tell you about the amazing work that fintechs are doing in emerging and frontier markets, why you should care from an impact perspective, from a risk perspective, and from a return perspective. The second part of it is we got to have the goods. It's not just a story you can tell. And so a big thing for us the last 3 years was institutionalizing our processes, our systems, our DD, our KYC. Because the second you start taking DFI, insurance money, so on and so forth, suddenly Lendable needs to meet the standards that the governments that entrust us with their money meet. And so we need to have the goods. We need to be able to show, no, we do indeed do all these things that you care about. We can deliver that type of information, the quality and the returns that you want. And so, it's really both on the education sales side, but it really is ultimately you have to return the returns they want, the information they want, and you can't lose money in any large quantity. And so there's no shortcut to it. Like, it takes years to build that track record. I mean, we have 5 years of track record, and only now can I have a European or American large institutional investor take us seriously when we walk into the room. This is 5 years in, $200 million later.
But the key thing that you sort of glossed over is that you've got so much capital now that you stopped even taking investments. So there is kind of, for the time
being, to be clear, we'll start again in Q1.
But it sounds like there is, maybe you never know whether the inflection point really turns into the hockey stick, eventually or not. But it does seem like perhaps if we wrap everything together from all the players on this call and and the trends, that there may be this new system or new approach emerging kind of outside of what had been, sort of, traditional channels. It is 8 minutes after. I see Yangbo's got his hand up, and he's a stalwart regular on the call. So maybe Yangbo, you want to have a word, and then we'll maybe go into what we think of as sort of the after party or happy hour. There's no drinks served, unfortunately, but people can hang out and trade contacts, and Jessica and I'll sort of take a step back.
Definitely, and thanks for the insights, and also call out here to Laneka for the follow-up about the ImpactAlpha Champions Program. So to Great just post this in the chat lately, and some early commentary. What has been the overall reception amongst investors across the African continent, not just African continent, but also diaspora, since just from numbers I've been getting several years ago around the UNHLPF, they're saying that if you take the estimated net worth of Zimbabwe nationals abroad, just for Zimbabwe, for example, it's, they say, triple the country's GDP, and the same in other places, even India. If you take net worth of Indian nationals abroad, it's actually greater than the entire country's GDP. So with those figures as potential indicators that if you're having trouble, if it can still be troublesome because of whether it's, for those who are familiar with Jillian Marcel's Triple B framework, bottlenecks or biases from investors from Global North, have you gotten any better reception amongst investors across Africa, which ties then into the imperative that if you're wanting to develop just financial infrastructure in Africa further, or all types of basic infrastructure and public utility across Africa further, it has to mean reinvesting more of the capital within the continent as opposed to shipping it abroad. So what have been your reactions, your perspectives? What other reception have you encountered on those fronts? And openness to all of you, Luyanda, Hilda, Daniel, and Daniel.
Hilda, you want to start?
Yeah, I thought Daniel Lendable was the right person to start this conversation, but happy to just mention that, Africa is, things have changed. I mean, look at the amount of capital that is currently flowing, even in terms of VC funding. I don't have the actual numbers, but they are out there. We're just talking of billions of dollars that are being investment. Look at just this year alone, just in Fintech. Crazy amounts of money. We're seeing more exits, happening, especially in Nigeria market, which is really getting faster than everyone of us is catching up, especially Kenya, which is, and of course, South Africa coming close to that kind of traction. But of course, the only thing I can summarize, because of the interest of time, the ecosystem is maturing. It has already matured. I think right now we're starting to see more capital flowing. I think the issue that's going to come in is more quality companies, more quality opportunities. And that is what is currently separating a lot of the opportunities of startups here. Can you be able to scale? Can you be able to get out of Kenya? Yes, you validated your model with M-Pesa. What happens after that? Can you go to Nigeria and really survive that market? So we're starting to see, everyone is being tested from the point of growth, from the point of scale following this maturity. And as someone said, the bubble has busted in Africa. Capital is immensely flowing. And of course, the most important thing for every company, including Pezesha, is going to be finding the right capital, finding the right investors to back us up, to ensure growth and scale to where we want to be in our vision in the end.
If I was to add to that, the People's Fund is doing its first equity raise. So this company has been bootstrapped from day one, right? For 4 years. We're doing our first equity raise right now. And one of the things we realized is when we started talking to potential funders, right? Is that to Hilda's point about there's a boom and a flow of capital. Unfortunately, in South Africa, it's run by pretty much only accountants, not former entrepreneurs. So it's private equity dressed up as venture capital. So when you step out of South Africa and you start looking at those conversations, there's a deep willingness, especially from the diaspora. I never know how to say that word. I've got a
Diaspora.
is a problem. There is a deep willingness, right? But Daniel touched on this, right? When you're a startup entrepreneur, I'm going to say it loosely, and no offense to myself and everyone in the call, you've got the mind of a rat. It's next meal, right? And the conversations are too elongated, like Daniel said, that it's too elongated to engage with properly. So why we even raising equity now is to set up the base so that we could do this properly, get the capital
right?
Properly. Right, and then you can do this properly and get the capital price right and have the long conversations without an air of desperation where they're going, yeah, these guys are closing down next month if we don't fund them, right? so that's been my experience, but the interest is definitely there. It's just right now it's still conversations, and it's very much conversations when you're running a startup. I mean, even South Africa, for example, there's a lot of capital that's operated. We had something similar to what Daniel had middle of this year, where we couldn't find projects in quickly enough. We had too much capital in the system, and we had a reputation of giving a good return. So when the capital sits idle, it's not earning the return it's supposed to, right? So we did have a small period of that, and then we fixed that, found more projects to fund. So yeah, that's my perspective. The interest is there. Personal experience is obviously we're still building this thing out, and it's my first equity raise of my life. I've been in business for 12 years. I've bootstrapped every business, so it's going to be quite an interesting journey, you know.
I think just two quick comments on it. One is, it's always important to remember that we don't exist in a vacuum, and actually we're this tiny little, flea on the back of the giant creature that is the financial market. And so when you look at the dynamics you're asking about around whether it's money held abroad or diaspora money, ultimately everyone in the world is comparing us to other local opportunities. And so as an old mentor of mine said, you can't sell someone a piece of property in a neighborhood they don't want. And so what that means is emerging frontier market investors, whether they're from there or not, are the only investors that will invest in emerging frontier markets. You're not going to convince a US focused investor to invest in Kenya. And so then they look at the other opportunities, and the primary opportunity that everything gets built up off of is the treasury bill. Unfortunately for the continent, and Africa is what I'm referring to, a lot of governments are running out of money. And so they use their treasury bills to crowd the market. So in Nigeria for a long time, the local treasury bill was yielding double-digit returns. In Kenya, the treasury bill for a long time was yielding 7 to 12, depending on the duration. And so then everyone compares you to that. Why would I invest debt in local currency in a fintech at the equivalent to the local currency, the local treasury bill rate, the government risk-free rate, or as close to risk-free as you can get in that country? And so that's what we're being compared to. And then corporate bonds are, a premium to that, and so on and so forth. And so to your point, the question is, what's the government doing? If the government is allowing for the private sector to thrive by not crowding it out, by increasing rates, as happened with Nigeria recently, where they lowered treasury bill rates, and guess what happened? Local currency started flowing to fintechs. And when they increase the treasury bill rates, which they're going to do again, guess what's going to happen? Capital is going to flow out of fintechs. So those are key dynamics to watch. And then the other thing I would just say is, let's not all get fat on the hog right now. What's happening in equity markets is non-sustainable, and it will end. And so what we're seeing when it comes to either the quantums of capital in equity markets or the prices that people are achieving on valuation is impossible to maintain. This is literally the worst price to earning ratio in the history of tracked markets, which means investors are getting a bad deal. And investors only get a bad deal for so long before they stop investing. And so I just as a market, I think we need to all come back to the rationality and sanity of when the equity stops flowing, which it will, how are we all going to band together to make sure that the thing, the next thing that happens isn't that everyone looks at our industry and goes, look at all these companies going out of business. So I think we really need to make sure that in the down period is when we really show our stripes and we really perform, so that when people start comparing us to developed market opportunities, they go, wow, these really are uncorrelated. These entrepreneurs really have built robust businesses that aren't, you know, just riding the highs and lows of the American market or the European market. And I think that's where we really earn our you know, credentials and get to prove that we built something really special.
Wow, good. Hey, we'll get to you, Ian, who has got your hand up. I just want to say two quick housekeeping things. One is that we were advised that there was a glitch in our Eventbrite integration, and it told some folks that the call was later. This call is actually earlier than we usually do them to accommodate you know, different time zones. So we're going to try to replay the video. You guys don't have to come back. We're gonna use the video, but we'll try to replay that at 1 Eastern time. So in a few hours we'll go again. And then the second thing is our next call, if you want to put it in your calendar, and we'll obviously pump this out in the brief, is Tuesday, November 30th, and that will be at 1 Eastern, as usual for us. And that one is the third of 3 Capitalism Reimagined calls in partnership with Omidyar Network. So Tuesday, November 30th, watch out in the brief, and we'll see you there again. And Ian, I don't know if you went away. Are you still there with your question?
I'm still here. Thank you very much, David. And look, first of all, apologize, I got to your call late, but fascinating discussion. I'm really excited to see so many, what I consider to be practitioners on the line here. Some of you know me. I work for the International Trade Center in Geneva, and we have thousands of beneficiaries across, you know, more than 120 countries or so. And these beneficiaries are kind of smaller enterprises below $3 million revenue average, and, you know, maybe a couple of 100,000, 500,000. Now, we have started to take serious look at the what we call sort of almost investment myopia paradigm of many people trying to look for longer term financing for ESG and social inclusion, all sorts of other reasons. And yet what we're getting back from our enterprises, more than 85% of them are telling us, hey, look, what we really need right now is short-term financing, and preferably with either zero or very, very low collateral, because there's nothing really much left in the tank right now. We want to pivot to new markets or find new buyers, and they're not going to give us an advance, you know, before they've seen our first shipment or whatever, and even in services. So we're really trying to address that question. And we've got some new partners that we're starting to work with on a pilot with Trade and Development Fund and Trade and Development Bank in COMESA countries in Africa. But I'd be really interested to hear from the participants here on this call, what their take is on the demand side for these smaller enterprises. And Hilda, I think, you were talking about this yourself. So for us, it's about, you know, what's the demand side? How can we service that best? And now we can really get these efficiencies in what we do, because we're a UN agency, and we really try our best to be efficient with our local partners. But that's the big thing for us. So Celo sounds like an exciting innovation. Thank you.
I don't know if Hilda is with us. I know Luyanda
has to drop off. Very quickly, you know, demand is, you know, it's always a chicken and egg, you know, trying to balance demand and supply. But of course, you know, on the side, you know, for us, you know, we are really focusing on origination, because we've figured out, you know, there's smarter ways to access affordable capital, and really matches the needs of our customers or our partners. And so on the demand side, you know, I think what we've seen really work, considering our model, is a collaborative approach, you know, working with partners, because it's really hard to figure out, you know, quality, for example, in our world, quality SMEs. Where do you find them, especially where there is a huge problem of data, you know? And so we've really identified the right partners in the value chain that can help us to understand, one, you know, these SMEs in terms of their behavior, what existing alternative data is there, and more so leverage on their network to then achieve a network effect in the end. So I think, you know, if I I think partnerships and of course, just leveraging on existing data in the market to guide proper segmentation of how to reach these customers.
Thank you, Hilda. I think you said all the right words there. We're really working hard on our data collection, our mapping and profiling, and all those things you mentioned. I think that's super critical. Well,
Terrific. This is exactly what we hope these calls achieve, is some interesting partnerships and connections. It's almost 25 after the hour now, so maybe we'll let everybody go to their next engagements, whatever time zone you're in. I think we are going to try to replay this, so let folks know if they missed it. We'll give them a replay, and then we'll obviously send out the link in our roundup on Friday in the brief. If you haven't subscribed to the brief, you should do that, and you'll be able to get notice of all of these calls and all the other resources of ImpactAlpha. Jessica, is there anything else we need to say? I want to we can thank everybody, and certainly all of the speakers, but all of the agents of impact here today. It's been terrific.
Yeah, thank you all. Thank you so much.
Okay, till next time.
Okay.
Bye-bye.
Bye, everyone.